A trend line is a bounding line for the price movement of a security. It is formed when a diagonal line can be drawn between a minimum of 3 or more price pivot points. A line can be drawn between any 2 points, but it does not qualify as a trend line until tested. Hence the need for the third point, the test. Trend lines are commonly used to decide entry and exit timing when trading securities. They can also be referred to as the Dutch line, as the concept was first used in Holland. A support trend line is formed when a security's price decreases and then rebounds at a pivot point that aligns with at least 2 previous support pivot points. Similarly, a resistance trend line is formed when a security's price increases and then rebounds at a pivot point that aligns with at least 2 previous resistance pivot points. Stock often begin or end trending because of a stock catalyst, such as a product launch or change in management. Trend lines are a simple and widely used technical analysis approach to judging entry and exit investment timing. To establish a trend line, historical data, typically presented in the format of a chart, is required. When establishing trend lines, it is important to choose a chart based on a price interval period that aligns with your trading strategy. Short-term traders tend to use charts based on interval periods such as 1 minute, with longer-term traders using price charts based on hourly, daily, weekly, and monthly interval periods. Trend lines are typically used with price charts. However, they can also be used with a range of technical analysis charts, such as moving average convergence, divergence, MACD, and relative strength index, RSI. Trend lines can be used to identify positive and negative trending charts, whereby a positive trending chart forms an upsloping line when the support and resistance pivot points are aligned, and a negative trending chart forms a downsloping line when the support and resistance pivot points are aligned.